Hello everyone. Today we're going to discuss the distinction between the IFRS and the US GAAP in terms of impairment of non-financial assets, primarily non-current assets, or primarily intangible assets and property, plant and equipment. So the distinction between the IFRS and Ind AS is minuscule. It's very less, or I can say there is not much of distinction between IFRS and Ind AS in terms of impairment of non-financial assets. But I found when I was reading US GAAP, I found there are 6 major differences in terms of impairment of non-financial assets. So anyone who is interested to evaluate and understand the differences between IFRS and US GAAP, here we go. So the first thing we will discuss is the impairment steps or the computation. Like all of we know, there is a steps on impairment, like we compute some fair value, we compute value in use. We will discuss. So what's the difference between IFRS and the US GAAP in terms of impairment computation? The second, impairment primarily based on certain indicators. So we will discuss the impairment indicators that are different in IFRS and in US GAAP. The third one, the reversal of impairment recognized. If I have recognized impairment loss in a particular year and based on certain indicators and calculations, and that indicator has changed in the favor of the entity, then what we're going to do? That we're going to discuss. The fourth topic we're going to discuss, impairment of non-financial asset at fair value. Suppose look, there are 2 methods under IFRS. Under IFRS, there are 2 methods to carry out non-financial assets or to carry out specifically property, plant and equipment at either cost or at fair value, or what we call this as revaluation model approach. If I'm using revaluation model as my base, then in such a case, what I'm gonna do, or what would be the treatment of impairment? The fifth concept is the concept of cash flows. Impairment, a major portion of the impairment computation deals with the cash flows. Now we will see what's the difference between the IFRS and the US GAAP. The last is the CGU. So CGU is the backbone of the impairment computation. CGU stands for cash generating unit. So my understanding is there is a difference between the CGU as defined in IFRS and as may be defined in US GAAP. So we will discuss. So these are the primary things that we are going to discuss over the videos. Distinction 1, impairment stages and the computation. So we are discussing this step after checking the indicators. So my primary assumption is that you have a basic understanding of how we book impairment under the IFRS or under the US GAAP. The first thing we do, we check for the indicators. Apart from 3 specific assets, that is goodwill, intangible asset that are for indefinite useful life and which are ready for use but not yet put to use. So apart from those 3 non-financial assets or non-current assets, what we do is like we check for indicators. If the indicator exists, we test the impairment. And then under the IFRS and under the US GAAP, what's the distinction? The major distinction is that under IFRS, it follows a single step approach. What does that mean? Under single step approach, what IFRS do is it asks the entity to compare the carrying amount, the amount at which you are carrying the asset, with the recoverable amount. If the carrying amount is more than the recoverable amount, so recoverable amount means a basic estimate of how much the entity may be able to generate from the asset, or what the market participant might be able to generate from the asset, the cash flow that they can generate from the asset. If we are carrying the asset over and above than the recoverable amount, then we need to book the impairment. So what's the recoverable amount? Recoverable amount is the higher of the fair value less cost to sell of the asset and the value in use. So always remember, when I talk about fair value, it deals with IFRS 13. So IFRS 13's primary approach is to think from the market's perspective. The first thing we check for the principal market transactions. So it talks about what is the amount that the market would be able to generate by using the asset, and it gives the liberty to the entity to think from its own perspective, or how much the entity would be able to generate by using the asset. Both of the case, we take the higher, what the market would be able to get or what the entity would be able to get. We take the recoverable amount as the higher between these two, and we compare with the carrying amount. So this is a single step model. This is what we do after understanding the indicators. Now when it comes to US GAAP, after understanding the indicators, US GAAP asks the entity to compare the carrying amount with the undiscounted cash flow. Mark my words, this is undiscounted cash flows from the asset. In both the cases, in the IFRS and in US GAAP, the cash flow is pre-tax cash flow. Mark my words, it is pre-tax. No difference between IFRS and US GAAP in terms of cash flows. So what it wants is, the first thing the entity would be able to do is to compare the carrying amount with the undiscounted cash flow that the entity is able to generate, which means this is entity specific. This is entity specific, what the entity would be able to generate from the asset. In a case where the carrying amount is more than the cash flow that the entity would be able to generate, then in such a case, the entity is required to compute the amount of impairment in step 2. So the amount of impairment would be the carrying amount less fair value of the asset, not cost to sell, nothing. Fair value means, one thing I want to say, whenever you are hearing the word called fair value anywhere in IFRS, the fair value should be computed as per IFRS 13. So you do not need to worry about the valuation model like we used to read the relative valuation, or we used to read cash flow valuations. It's all covered under IFRS 13. The only thing you need to do as an accountant, you need to think from the IFRS 13 perspective. So in order to summarize the distinction one, IFRS is a single step model. What IFRS do is just compare the carrying amount with the recoverable amount. A recoverable amount is the higher of what the market can earn, what the entity can earn. And the difference is your impairment loss. Impairment, not impairment gain. I'm talking about impairment loss. Then in case of US GAAP, the first thing you need to do, or the entity need to do, is to compare the carrying amount with the undiscounted cash flow. If the carrying amount is more than the undiscounted cash flow, then the entity is required to impair, and the impairment amount would be calculated as the difference between the carrying amount and the fair value of the asset. Here it is cost to sell, here it is fair value. Simple fair value of the assets. So let's discuss about the second and third distinction in IFRS versus US GAAP. The interest rate, the impairment indicator. Interest rate movement is one of the most important indicators in case of IFRS, but US GAAP does not specify to be an indicator in case of movement of interest rates. Now, the reason primarily what I think is, we generally here take the undiscounted cash flows as a part of my valuation, as a part of the entity's ability to generate the cash in stage 1. We generally take the undiscounted cash flow. That's why this may be the reason that the movement in interest rate is not considered as one of the impairment indicator, but as we take the discounted cash flows for the purpose of computation of value in use. So if the interest rate in the market goes up, the value in use will come down, which means then in such a case there may be chances that the asset might be impaired. So this is one of the reasons that movement in interest rate is considered as an indicator under IFRS. The third distinction is the reversal of impairment loss. Suppose the carrying amount is 100 rupee, the carrying amount, and the recoverable amount coming out to be 80 rupees. Then in such a case, we have booked an impairment loss of 20 rupees based on certain calculations. And what happens after that, the indicators have changed in favor of the entity, and based on my computation now, the value in use or the higher of value in use or the fair value less cost to sell, that is the carrying amount, is coming out to be 110. Then in such a case, the carrying amount is 100, the recoverable amount is 110. Then one may think that we need to reverse the impairment that we have booked because the circumstances has changed. IFRS allows to reverse the impairment loss. It allows to reverse the impairment loss except in case of goodwill. It does not allow in case of goodwill, but in case of US GAAP it is prohibited. Once you have booked the impairment loss, it is not reversible, but in case of IFRS it is reversible. The fourth indicator is the impairment requirement for impairment in case of revalued assets. So under IFRS there are two methods that an entity can use in order to account for non-current assets, or basically non-financial assets, or if I simplify for PPE, there are two methods. Either they can go for cost method or they can go to revaluation model or revaluation method, but the same is prohibited under US GAAP. So under US GAAP there is only one method, that is cost method. So all the discussion that we are going to have in this case is not relevant in case of US GAAP. So when it comes to the IFRS, let's discuss through the help of an example. Suppose the carrying amount of an asset is $1 lakh. Then how carrying amount came up to $1 lakh? I purchased the asset, or the entity has purchased the asset for $80,000, and there is an upward revaluation in the value of the asset to the tune of 20,000. So the cost comprises, so the carrying amount comprises, cost 80,000 and the revaluation amount of 20,000. So which means the balance in the revaluation reserve in terms of that particular asset is $20,000. So now what happened? The indicators has came up that the entity is not performing good, or something has happened that meet the requirement to test the impairment, and we've tested the impairment and we came up to two scenarios, where in scenario 1 the impairment amount is 16,000. This is not the recoverable amount, this is the impairment loss. Now the impairment loss that the entity has to recognize is $16,000, and in case number 2 it is $24,000. So now let's discuss how can we account them. So if you can see, the balance in the revaluation reserve is 20,000, which means we have we did an upward revaluation to the tune of 20,000. Now as there is an impairment indicator and there's an impairment loss of 16,000, what we're gonna do, we're gonna adjust this 16,000 with the upward revaluation first. After that, if there are still impairment loss to be recognized, as it is there in case number 2. Look, in case number 2 the impairment requirement is 24,000, but the balance in the revaluation reserve in terms of that particular asset is 20,000. So what we're gonna do, we're gonna transfer directly to the equity through the help of other comprehensive income 20,000, and we're gonna charge the impairment loss to the tune of 4,000 in the profit and loss account. So this is the total difference between the two cases. So I will summarize. If there is an upward revaluation, the first thing the entities need to do is, if there is an impairment loss, the entity needs to adjust the impairment loss from the upward revaluation balance in the revaluation reserve through the help of routing it through other comprehensive income, just like 16,000. If still there is pending revaluation impairment loss to be recognized, the balance will go to profit and loss account. As in this case 4,000, as 20,000 is already adjusted through revaluation reserve, and 4,000 will go to profit and loss account. The same thing is not applicable in case of US GAAP because there is no concept of revaluation. That's it. fifth distinction is the concept of cash flows. Like the concept of cash flows are both similar in case of IFRS and US GAAP, but there are certain distinctions that we need to discuss. The first distinction is the prescription or the guidance that has been provided in IFRS is more prescriptive or more descriptive in case of IFRS, but it's less descriptive in case of US GAAP. So US GAAP does not mention more about the cash flows as compared to the IFRS. So on an overall basis, the cash inflow should be from the continuous use of the asset, and the cash outflow should be the relevant cash outflows, like which are necessary to be incurred, and any disposal cost we need to consider in case of both IFRS and in case of US GAAP. But IFRS specify one specific thing is the restructuring cost or any gains or any restructuring plans that the entity is going to have. So any cash flow that are expected to arise from the future restructuring or improvement program should be excluded from the computation of cash flow. And two checks that has been provided in IFRS in terms of computing the cash flow. The first thing IFRS says, it is very difficult for the management to project cash flow for more than 5 years. So what they did is, like, the management should be able to estimate at a maximum of 1, 2, 3, 4, 5. They need to estimate for a period of 5 years the cash flows and the figures that the entity is able to get from the use of the asset, and after that they should use a constant growth rate or a growth rate which should not exceed the industry and arrive at a terminal value, which means they want a two-step valuation to be done. The first step is the growth phase, during which the IFRS says that it should not exceed the 5 year, which means the growth period or the estimation period of each and every item should not exceed 5 years. If it exceeds, in such a case there has to be justifiable reason, and after 5 years the entity is able to, like, the entity should compute a terminal value and pull them to pull them to Y0, which means that they should make estimate for a period of 5 years, not more than that, and after 5 years they should calculate the amount of terminal value, because it is very difficult for someone to estimate the appropriate or exact cash flow for a period of more than 5 years. So in order to conclude, IFRS says the management's projections and budget should not exceed a period of 5 years based on the two-stage model, that is the growth stage and the terminal stage. And after that, after a period of 5 years, in order to compute those cash flow, in order to account for those cash flow, they should use a growth rate and they should stabilize it, and that is primarily deals with the computation of your terminal value. For example, I know it's a bit complicated, but I want to explain it through the help of an example. This is Y0, 1, 2, 3, 4, 5. The standard wants them to make an estimate max to max for a period of 5 years. Okay, we will get this much, this much, this much, this much, and this much of cash flow from the use of the asset. Pull them to year 0 through the help of your discount rate. After year 5, they want to make the entity compute a terminal value by taking a declining or steady growth rate, and that growth rate at which the cash flow will grow should not exceed the industry growth rate or the peers in which the entities with whom the entity is operating, and pull them back to Y0. So this is the whole concept is given in IFRS, which is not there in US GAAP. So this is all I want to say in terms of the cash flows. Last but not the least, distinction number 6 in terms of concept of CGU. CGU deals with the cash generating unit. So IFRS defines cash generating unit is primarily the smallest identifiable group of assets that generate cash inflows and that are largely independent of cash flows from other assets or group of assets, which means that CGUs should have the independent capability to generate cash flows for the entity, which means they are not dependent on the other assets to generate cash flows. That is the main concept of IFRS, and what IFRS does is it compares the recoverable amount of the CGUs and compare with the carrying amount of CGU and allocate the impairment losses. But on the US GAAP, there is primarily no concept of CGU. The only thing that they have mentioned is like, for the purpose of recognition and measurement of an impairment loss, a long-lived asset or assets group should represent the lowest level for which the entity can identify cash flows that are largely independent of cash flows of other assets and liabilities. So they also speaks about something on CGUs, but they do not use the term CGU for the purpose of computing the impairment losses. So one may think that the concept is not there, but overall basis, both are on an overall basis, if I can say, both are primarily the same concept on an overall basis. No need to worry like how can I allocate the impairment losses, the CGU concept is not there. It is there, but the word has not been used. So primarily they are same, but one should be careful regarding the implication.